What is an adjustable rate mortgage? An adjustable rate mortgage is a mortgage whose interest rate adjusts on a regular basis. Typically it would be monthly, every 6 months, or once a year. Adjustable rate mortgages are based on an index, which is the adjustable rate portion. For example, LIBOR or prime rate are indexes. And then a margin, typically between 0 to 3%. So for example, if you were to get a mortgage today that was based on LIBOR plus a 2% margin, LIBOR is 1.3% currently, you add the 2% on top, you now have a 3.3% interest rate. And then as that index or LIBOR goes up or down, your interest rate adjusts and changes accordingly. And for example, most typical first rate mortgages come with typically a long initial period where the rate is fixed, whether it's a 3-1, 5-1, 7-1, or 10-1 ARM. What that means, for example, a 5-1 ARM means the first adjustment comes in 5 years. So the rate is fixed for 5 years, and then it adjusts. That's the 5 part. Then the 1 part means it adjusts every 1 year thereafter. So typically that 5-1 ARM is the upfront rate is slightly higher than the index plus margin because you had the benefit of having the rate locked in for 5 years. And then at that point thereafter, it would adjust. It would be strictly what is LIBOR plus whatever the margin is. In the case I'm discussing, that would be 2% would be the margin. Typically, these are always slightly lower than the current 30-year fixed. You pay a much higher premium to fix the rate for 30 years, so the rate's slightly higher. The advantage of the fixed rate is, of course, you're protected from upward movement in that index. Happy mortgage hunting.